This is Stephen Keel. I'm the portfolio manager for Arquitos Capital. This is a reproduction of the presentation that I had given at our Arquitos' annual meeting on September 10th, 2018 in New York. And if I could just ask in advance that this presentation not be shared with anyone who I have not shared it directly with. It is confidential, and the idea is for investors who were unable to attend the event and for other interested parties. As we begin, I wanted to thank those who were able to attend. We had a great turnout of about 30 people or so. It was held downstairs from our office on 67th Street. We had great turnout from staff members at Willow Oak Asset Management. Willow Oak is the subsidiary to Enterprise Diversified, or Andy, in which Arquitos holds a controlling stake. So it was good to see those people. And we'll have about 12, 13 slides or so here. And once we get through them, always happy to answer any questions offline. Feel free to send me an email or give our office a call. So what is Arquitos exactly? I mean, I love this quote from David Foster Wallace, a little bit unique for an investment firm to be quoting someone like him. But the idea is, how do you think? And as a portfolio manager, how do we think? How do we control what we think? And how do we make good decisions from that? I mean, that's the bottleneck, essentially. The edge is judgment. It's not always additional information. It's how that information is processed. So I definitely take pride in being unconventional. Our primary concern is that idea of how to think and what meaning to take from the different information that I'm presented with. The secondary concern really is the security analysis itself. I mean, that's a prerequisite for being able to make those judgments as to allocation size, whether the particular company has the risk profile that I'm interested in, and things of that nature. But fundamentally, my belief is that most of investing, probably 85% or more, is actually the psychological side, understanding the biases, the kind of self-assessment, intellectual honesty, self-awareness, and I think that's really where our advantage, we have advantage over long time periods. So the opportunities, oftentimes when you look at security analysis by itself or quantitative analysis, they're often fairly obvious, but it's difficult to take advantage of them for investors at any given time. So the idea is how to prepare in advance to take advantage of opportunities that might come up in the future. So the focus on being self-aware of limitations, the intellectual honesty of the reviewing both mistakes and mistakes of commission, and also mistakes of omission are important. I approach the idea basically that all investing is arbitrage. There's three primary arbitrage opportunities. There's time arbitrage, of course, when our holding period could be longer than maybe the rest of the market, and that's a large, it's really a large advantage. I mean, time arbitrage by itself should give us a great chance to beat the market over time, and that requires the discipline to hold things during periods of volatility. There's information arbitrage, and oftentimes that's because of smaller companies, companies that aren't as followed by analysts or other larger funds. And this is oftentimes where again, microcaps, small caps, mid caps even, or companies that are just not as well known can provide us with an advantage. The emotional arbitrage is the third primary kind of method of arbitrage that I use, and that's the idea of really being a contrarian, being willing to own things and buy companies when they're out of favor, when there might be headline risk, or there might be we might be at a certain part of the economic cycle where certain industries are unloved. So we've been successful by constantly reminding myself of these arbitrages and really trying to maintain the discipline to abide by them, to not be distracted by volatility, and to attempt to take advantage of volatility, and also to really be humble about what information we have, whether it's valuable, what's valuable about it, and what judgments and what meanings do we take from that information? Of course, we couldn't do anything here without all of our great investors. We started the fund in April 10th, 2012, the onshore fund. And then just earlier this year in March, we started the offshore fund, which is the BVI, British Virgin Islands Fund. So we have 82 investors and nearly 30 million under management. Investors from 18 different states, 12 different countries, and just a really great group of long-term committed investors, which include individuals, high net worth individuals, family offices. We have a small insurance company and other types of institutional investors as well. And looking forward to expanding that over time, and certainly could not do what I do as a portfolio manager without the alignment of interests amongst the great group of investors we have, and the investing style and philosophy. I am a significant investor as well, myself and my immediate family, and will always have the vast majority of my net worth in the fund itself. And here are the fund's service providers, prime broker, administrator, auditor, etc., legal. One thing to note here is that on the operational side, Willow Oak Asset Management, again, the subsidiary of Indy, we are starting through Willow Oak a fund, an outsourced fund management services program to assist the management company of funds. Arquitos is coming on board. Willow Oak already offers this to the funds associated with them, 3 different funds there: Bonhoeffer Capital, Willow Oak Select, and Alluvial Fund. And so Arquitos is the first external fund coming on board to receive those services, and that'll handle things like investor relations, liaisoning between the fund service providers, and other things like that. So keep an eye out for the announcement there. It should come any day now, and looking forward to, over time, offering this service to additional outside funds. Here's our performance through the end of August 2018 from the inception. So even though we started the offshore fund earlier this year, we're using the results here from the onshore fund. The terms are the same, and ultimately the results are going to be very similar. So since launch on April 10, 2012 through August 30th, 2018, the net to investors was about 29.8%. And look, I mean, we definitely want to view this over a 3 to 5 year time period. We're long-term oriented. We want to be able to get that compounding effect. And so 1 year time periods, no matter what, even the great return over last year or the poor return from 2015 or this year, is far too short of a time period to make any judgments. And so I urge you to look at it over 3 to 5, 7 years, even longer. Ultimately, you should not have cash in the fund that you need over the next few years, and that helps you ride through any potential volatility. Volatility happens. It's happened this year. It happened a few years ago, and my job as a portfolio manager is to, of course, stay disciplined and try to use that to our advantage. So what has happened in 2018 so far? Well, our major positions, and we'll talk about this later in the presentation, are Indy, our publicly controlled vehicle, West Aim, MMA Capital, and things like that. So, but how have the things affected this year, 2018? SiteStar was up 12% on the year. Boston Omaha, which we had made some changes to the size in the portfolio earlier this year, was down 38%. And Bank of America warrants, for example, were down significantly as well at the time of this presentation. So those are things that had kind of affected this year's portfolio. Last year, the main drivers: Intra-West Resorts. This was a company that was bought out earlier in the year in 2017. Was a major contributor. Indy was a major contributor as well, as were the Bank of America warrants, Boston Omaha, and some other companies like that. In fact, 2017, really everything we owned went well. MMA Capital as well. I've written about this in the quarterly letters, but just to give a brief overview there. The volatility again, we have to look as value investors, as long-term focused investors. We have to view volatility as our friend. Buffett recently wrote in the Berkshire annual letter that Berkshire itself was down 50% on 3 occasions in its history. And each one of those was really an incredible buying opportunity. But unfortunately, I'm sure some Berkshire investors in this time period, like 1974, and 1999, I'm sure some of these investors, I'm sure a great deal of the investors, quite frankly, those who followed along closely, just couldn't handle it and ended up being selling. And if they did that, they really missed out on all of that compounding effect over that long time period of Berkshire. So, if we're long-term investors and we're looking at 3 to 5, 7-year time periods, the monthly statements that we send out should really be ignored. There's really no takeaway from those results. And if the volatility, both good and bad, if there's a way for us to take advantage of, for me to take advantage of it, either by selling something because things get overpriced or buying it because it's underpriced, that's really the only purpose of the volatility. And if you as an investor aren't planning on doing anything one way or the other, adding money or taking money out, it just doesn't really help to get distracted by that. I mean, it's the main problem with short-term performance. And again, I say this in our history, it's mostly been good over a month or two or a quarter period. The problem is, as an investor, it makes it more difficult to keep your discipline, and quite frankly, it makes it easier to kind of get overly excited or to get overly pessimistic as things swing one way or the other. So I would just urge you to know yourself and don't put too much stock into any kind of short-term performance. And here's the growth of $100,000 since inception, Arquitos Capital and S&P compared to the S&P 500. So it looks like we've gone up to about 520,000 or so dollars through the end of August. That's what $100,000 was worth. And then this lower chart is the monthly performance. You can see there's not a ton of correlation, not much correlation actually at all between Arquitos and the S&P 500. To give an example of compounding, in my first investor letter, I wrote about Back to the Future, the movie Back to the Future, Marty McFly. And it's hard to believe that that's been 33 years since that movie came out. But the idea was, what if Marty McFly, instead of coming, he went back to the year 1955, and instead of coming back to the future, he sold a DeLorean and invested his money, for example. And what kind of effect would have you had over time? If you would have come across Buffett, who, as many of you know, Buffett ran a hedge fund before Berkshire Hathaway, about that similar time period. During the time he ran that hedge fund, it was over 12, 13 years or so, he returned about 26% a year, beat the market by about 16.5% a year. So if Marty McFly would have sold the DeLorean, for example, taken that money, come across Buffett, invested in Buffett, never added another dime into the fund, just put the $100,000 in, that 26% a year over 30 years would have turned into $100 million. And that's just setting it aside, not looking at any statements, not worrying about the performance over a month or quarter, a year, or even in some cases 5, 7, 10 years. And that's the type of effect that compounding can have over long time periods. Now it gets even crazier. Now Buffett's been doing this for 60 plus years, and granted 26% a year is an astronomical return over extended time periods. But if Marty McFly, if the DeLorean, he put $100,000 in 1955, if you would have fast forwarded to 50 years to 2005, that number, $100,000 would have been worth 10 billion. So it just goes to show how dramatic a one-time investment decision can have. And then it's the constant discipline to keep it in there and to understand what the compounding effect on kind of long time duration can have. To make things more reasonable, 26% a year is an unreasonable expectation to be able to get a return like that over really extended time periods. But 15% is a reasonable goal. I mean, again, that's a astronomical return, beats the market by more than 5% a year over the historical returns of the market. But there have been a great group of investors who've been able to do that for decades and decades at a time. And so here's an example of that. What does that $100,000 compound to? And 50%, again, this is a great return. So if you look at over a 25-year time period, doing that 15% return, you get about $3.3 million off of that $100,000 start. And compare it to, let's just say, the market with dividends are invested, and if the future is able to do what the past had done, which is maybe unreasonable, but the SP 500 had done about 10% a year, you're a little bit above $1 million there. And so that 5% a year difference is really astronomical. For Arquitos, we've been able to do 29.8% net to investors over a little bit more than 6 years there. And you see, basically, we're at the same level, to a little bit above $500,000. So we've been able to accomplish in a little bit more than 6 years, which would have taken almost 12 years for the 15% return, or almost 17 years for the market return. So can we get some delayed gratification? If you can do 15% a year, for example, what is that worth in 30 years? Well, at 25 years, we're at 3.3 million. And then over the next 5 years, it doubles again. So when you get 15% a year over every 5-year period, it doubles. So at 6.6 million at 30 years, and at 50 years, it's 106 million. So, if it's important to be able to start early, to have a long time duration, to in some cases have intergenerational compounding, and that's how these numbers really become astronomical over time. So 15% a year over 50 years, starting with $100,000, leads you to $106 million. So Arquitos' top 3 holdings here: Indy, Enterprise Diversified, again, the public company we control, MMA Capital, and Westaim are the 3 main, our 3 largest holdings. Indy is interesting. So I recently stepped up to be a chairman. I was a CEO of the company since the beginning when we took it over, December 2015. Recently was bumped up to chairman, and we put in a full-time CEO, Mike Bridge. So we're excited about what that future holds. Indy has a group of diverse subsidiaries, but the primary subsidiary is that Willow Oak Asset Management. Willow Oak has interests in 3 funds: Alluvial Fund, with Dave Waters, that was launched in January 1st, 2017. Dave's a great investor, and that fund has gotten off to a tremendous start over the last almost 2 years. Bonhoeffer Fund, run by Keith Smith. Keith is on the board of Indy, director, a good friend as well, and is also a tremendous investor. That was started in July 1st, 2017, and things have been going very well there as well. And then recently, on August 1st, 2018, we started a new fund called Willow Oak Select. And this fund is run by Rodney Lake. Rodney previously worked in the endowment office at George Washington University. He also runs a value investing program there, and is the part-time COO of SiteStar Indy as well. And Rodney is running this Willow Oak Select in a way where we're curating best ideas from outside fund managers, and in fact, actually paying out some of the performance fees predetermined to those submissions. And so this is kind of a best ideas fund where we think over time we can do very well, and it helps to cultivate the relationships amongst a great network of other fund managers. MMA Capital, MMA we've owned for a long time. It is a really fascinating situation. Earlier this year, they essentially sold the company, although it is still remaining publicly traded, but the management and most of the operations were sold to a private company, and they now operate on a services contract with MMA. MMA has some tax benefits going forward. They have a pile of cash. They continue to buy back shares. They've been buying back 12% of the company a year for the last 5-6 years. And the senior management there are well aligned. They're all large insider shareholders, and they also continue to buy shares on the open market. So it's again, interesting company. Without getting into too many details with the operations, it trades significantly below book value and below the price that the private company, Hunt Companies, basically took control of it. So I think there's still a great long-term future there, not only to get back up or to get to book value, quote unquote, its liquidation value, given their holdings, but they also have some interesting transition opportunities in terms of their income statement with some existing relationships. Both they run a fund, for example, the solar lending fund in partnership with Bank of America, and that fund has been successful, throws off a nice amount of cash for the company, and as well as some of their other holdings. And the third one is Westaim. Westaim is a Canadian company. They have an insurance subsidiary, and then they have a credit fund. And I've written about Westaim in quarterly letters as well, but here we are, trades below book value, or right at or below book value, and they've received offers for their insurance company that value it higher than the market values it currently. And then the credit fund is continuing to grow and attract additional assets. And as that happens, of course, that reflects well on the book value. And back to the insurance company has really improved their operations the last few years. They're now profitable, combined ratio below 100, have some additional opportunities to cut costs. And we'll see where it goes from there. But the safety there with especially MMA and Westaim is the price. Both of them are trade below book value, and there's both a future there for the market to close that gap, and then also as part of their transition into income statement characteristics, free cash flow generation, and things of that nature will attract a whole new set of investors and help to allow the stock price to kind of be more appropriate to what the operations of these companies, but also the capital allocation expertise at the leadership of each of these companies. Fundamentally, risk management, from my perspective, is alignment of interests. It's qualitative in nature, not as quantitative. And so how do we get that alignment of interest? Well, first of all, personally, me as a portfolio manager, I mean, my alignment to the fund is to have skin in the game, to have a significant investment in the fund, and to make decisions based on that, managing your money in the same way that I manage my own and my family's. For you, your alignment is really the time horizon and appreciation for the philosophy that you're in agreement with the way I approach things. I approach risk management. I approach portfolio management, allocation. Understanding that, for example, we are a concentrated portfolio and primarily made up of companies that trade at or below book value, that have also potential to transition into really cash generators, free cash flow generators in the future. And we have a group of companies that are in various stages of doing that, generally have a low amount of risk because there's a low amount of debt, and because the price is reasonable. And then the portfolio itself, that I'm looking for the same thing from the capital allocators and the leadership and decision makers at the companies that we own within the portfolio. That's insider ownership. There's share buybacks at appropriate prices and with appropriate capital allocation decision making, and shareholder-friendly policies. I mean, we are passive investors for the most part, except for our relationship with Indy. For the rest of these companies, we're passive investors, and we're relying on the decisions made by those capital allocators to that company. And so we're looking for people who are good capital allocators, who are conservative in nature and who make decisions in a rational way. With risk management, how do we help? Well, no leverage, no margin leverage, for example. We never want to be forced out of a position. We might own long-dated options or something along those lines, some warrants like we did with Bank of America, but it's fairly rare and is a small piece of the portfolio. But the margin leverage we don't have, and the reason for that is because we never want to be in a situation where we have to sell because the price goes down, even if operations are going well. Again, the misaligned investor base, that's a massive risk, and this is a reason why a lot of funds, hedge funds, don't have the resiliency necessary to exist over long time periods. Thankfully, we've got a great group of diversified investors in the fund, and they're all aligned with what we're trying to do. And aligned on the time duration as well. And then the temperament, this is the psychological things I talked about earlier. And I really think that discipline and resiliency is so important. It might be the most important thing, to make sure that the fund itself is resilient, that the decisions about buying and selling and owning at any given time of the portfolio companies, that I can remain disciplined doing so. Again, the security analysis itself, the quantitative, having the ability to understand opportunities on the quantitative side and through the analysis of the companies themselves, that's really a prerequisite here. But how do we do even better than that? And I think that's where the psychological side comes in. My job as a portfolio manager is to challenge assumptions. So this artwork here, everything you know is wrong. I really like this, and the key word is no, because the market generally is going to be correct. So how can I remain humble? I want to remain humble that the market in most cases is correct, but there are certain times where the market's not correct, and I have to be confident enough to take advantage of those opportunities. And that idea that that what the market knows, quote unquote, is sometimes mistaken. So the key is how to determine the times where that's the case. There's a great quote as well. It's been attributed to several different sources, but it ain't what you know that gets you into trouble. It's what you know for sure that just ain't so. And something we try to keep in mind as well. And again, this Edward de Bono quote is great regarding perception. I mean, ultimately, what meaning do we take from information? What's our perception of that information as opposed to the reality? And ultimately, I am arbitraging the perception versus reality. Perception is the price, the stock price at any given time. And the reality is the operational success, the long-term potential of a particular company that we're invested in. So this is essentially what we have here. I try to take a little bit of a different approach. Here's the contact information, other information here with Arquitos. And again, happy to answer any additional questions that you might have. I am in New York, not full-time, but occasionally, and each month. So happy to meet up there. Or to discuss things over the phone as well. I want to thank you for continuing to be aligned with the fund, being committed, having an appreciation for the long-term compounding effect that we're trying to do, and an appreciation for the style. We've had a great group of investors, a tremendous 6.5 years, and look forward to again, I've got a long kind of time duration here. Looking forward to doing this for another 20, 30, 40 years or so, and I hope you'll be joining me along that entire time period. So thank you again for listening here, and hope to see you at next year's annual meeting.